In early January 2026, U.S. forces executed Operation Absolute Resolve, capturing Venezuelan President Nicolás Maduro in Caracas and flying him to New York to face narco-terrorism charges. This wasn't just a geopolitical earthquake. It sent shockwaves through global markets. Today, we're breaking down which stocks are soaring, which are sinking, and what investors should do right now. Here's what surprised everyone. Markets didn't panic. Let's start with the monster winners. Energy stocks absolutely exploded. Chevron surged 5.1%, and here's why: they're the crown jewel. Chevron is the only major U.S. oil company currently operating in Venezuela. They're first in line to lead the production, recovery, and rebuild efforts. ExxonMobil rose 2.2%, and ConocoPhillips gained 2.6%. ConocoPhillips has nearly $10 billion in outstanding arbitration claims from Venezuela's 2007 nationalization. Exxon's claims are around $2 billion. A new regime could finally pay these out. But the real explosion: oilfield services companies. Halliburton surged 7.8%, Schlumberger rocketed nearly 9%, and Baker Hughes posted gains between 7 to 9%. Why? Venezuela's oil infrastructure is completely broken. Rebuilding it is a multi-billion-dollar, multi-year project, and only these firms can do it at scale. Refiners also celebrated. Valero and Phillips 66 both rose around 7%. Venezuelan heavy crude is exactly what U.S. Gulf Coast refineries are built to process. But here's the reality check. Experts say significantly boosting Venezuela's production could cost over $100 billion and take at least a decade. J.P. Morgan is more optimistic, suggesting 1.3 to 1.4 million barrels per day within 2 years. But Rystad Energy warns Venezuela could end up like post-Gaddafi Libya if instability persists. The second massive winner: defense contractors. Lockheed Martin rose over 2%. RTX Corporation hit an all-time high, climbing 2.1% to $190. Northrop Grumman advanced more than 4%, and General Dynamics added 3.5%. Smaller defense tech names went even crazier. Environment surged 12%, and Red Cat gained 11%. It's not just U.S. companies. Global defense stocks rallied hard. Rheinmetall in Germany gained over 9%. Hensoldt rose more than 8%, and Leonardo in Italy and Saab in Sweden both added more than 6%. Mitsubishi Heavy Industries in Japan rose more than 8%. One analyst called Maduro's overthrow a signaling exercise, a message that we're re-entering an era of hard power that will drive rearmament globally, especially in Europe and Asia. The Trump corollary is not mere bluster. Interestingly, both risk assets and safe havens rose together, a sign investors wanted some insurance but weren't panicking. Gold gained 2.8%. Silver absolutely soared 7.9%. Precious metals miners rallied as investors sought protection against potential geopolitical shocks. Even Bitcoin rose to $94,700 since mid-November. Coinbase jumped 7.8%, and Robinhood Markets jumped 7% on the crypto enthusiasm. Now let's talk about who's getting crushed. Canadian oil producers took a hit. Why? Venezuelan heavy crude competes directly with Canadian oil sands in U.S. refineries. If Venezuelan barrels flood back, companies like Suncor Energy, Canadian Natural Resources, and Cenovus Energy face serious pricing pressure. Their market advantage could evaporate. Airlines faced immediate disruptions. Hundreds of Caribbean flights were canceled due to FAA restrictions and regional instability. Short-term pain from chaos, plus higher fuel costs if oil prices stay elevated. Here's a big one. Oil prices themselves might crash long-term. Right now, crude jumped 1.7% on the news. But analyst Tony Frangi predicts sub-$50 WTI. The oil market is already oversupplied, and Venezuela just adds more pressure. Oil prices already posted their biggest annual decline in 5 years in 2025. Emerging markets face headwinds. Uncertainty over Venezuela could trigger capital flight from Latin America, pressuring regional assets as investors de-risk. And there's China risk. China is Venezuela's biggest oil customer and has lent the country over $60 billion. Peter Chur of Academy Securities warns that U.S. actions to reclaim oil rights will be fought in the courts as China has to protect their own interests or face not just economic losses, but loss of face. It's likely Chinese diplomats didn't escape before the operation, sending Beijing a very clear message. So what should you actually do with this information? Let's break it into buy, hold, and avoid categories. First, the pick and shovel play. Halliburton and Schlumberger. Regardless of who runs Venezuela, that infrastructure must be rebuilt. This creates a multi-year revenue pipeline. These are your highest conviction plays right now. Energy majors with Venezuelan exposure: Chevron, ExxonMobil, and ConocoPhillips. But understand, much of Chevron's 6% jump is already priced in. Long-term gains depend on actual production numbers, which could take years. Safe haven insurance, gold and silver. Analysts recommend a modest 5 to 10% portfolio allocation as insurance against further geopolitical shocks throughout 2026. Gold has been hitting record highs throughout 2025. Defense contractors: Lockheed Martin, RTX, Northrop Grumman, General Dynamics. The geopolitical tension narrative supports these long-term for your hold list. Broad market ETFs like SPY and QQQ. Historically, geopolitical shocks have minimal lasting impact. Over the last 11 major events, the S&P 500 averaged just 0.3% lower 1 week after, and 7.7% higher 12 months later. Don't panic. Sell. Major U.S. banks like JP Morgan and Bank of America are also worth holding. They benefit from risk-on sentiment and potential Venezuelan reconstruction financing. But this isn't their primary driver. The same goes for refiners like Valero, Marathon, and Phillips 66. They could be massive medium-term winners, but the timing is uncertain. Finally, what to avoid. Don't bet on quick gasoline price drops. Analysts say significant production increases could take until 2030 to materialize. Venezuela currently produces only about 1% of global output. This isn't an immediate game changer. Also avoid Canadian heavy crude producers like Suncor and Cenovus. If Venezuelan supply returns, they face direct competitive pressure, and avoid panic-driven trades. The VIX Volatility Index sits well below stress levels. Markets aren't paying up for protection because they don't see systemic risk. Here are 5 critical signals to monitor in the coming weeks. 1. Credit spreads. High-yield and emerging market spreads are key credit markets, often price stress earlier than equities. 2. Real bond yields. These remain elevated. Inflation expectations are stable, suggesting no meaningful change in the growth outlook yet. 3. Oil supply forecasts. The oil market appears to be in a lasting surplus. 4. Geopolitical precedent. The real long-term risk is whether this sets a precedent affecting behavior elsewhere, particularly around Taiwan. And 5. The VIX. If this spikes above 20 to 25, it signals genuine market stress. We're not there yet. Here's the bottom line. Markets view this as a short-term opportunity for energy and defense stocks, not a systemic global risk. It's seen as geopolitical realignment rather than crisis. Bullish for us assertiveness, but with significant execution risks. Fundamental ZI growth, corporate earnings, and Federal Reserve policy will remain the primary market drivers. Venezuela represents headline risk, not a fundamental shift in investment strategy for most portfolios. UBS forecasts nearly 10% earnings growth for global stocks in both 2026 and 2027. They advise underexposed investors to put excess cash toward stocks while maintaining gold allocations as insurance. Remember, this is factual analysis, not personalized financial advice. Always consult with a licensed financial advisor before making investment decisions. If you found this breakdown valuable, smash that like button and subscribe for more market analysis. Drop a comment below. Which stocks are you watching most closely? Thanks for watching, and I'll see you in the next one.